My name is Jay Norris. Today's topic, statistical validation. It really is the end game in trading education. It marks the end of where you realize that your analysis works for you, and you realize it's time to trade. It's time to start taking every trade. When we look at Trading University, when we look at how to improve our trading, I often quickly realize, well, we're not trading enough. And once you do have it figured out, then that's the problem. Probably your biggest mistakes are missing trades, and we'll get to that. As always, we need to remind you that trading involves risk of loss and is not suitable for everybody. Eduardo, I haven't been prompted by it yet. Not sure, Eduardo. Maybe FX Street can address that. Hello, Forex Lady. Good to see you again. Let me take care of one thing here. Let me turn off my Skype here. Hopefully that's not interfering. We'll close the email. Again, trading involves risk of loss and is not suitable for all investors, and we really mean that, definitely. You have to be aware of that. Statistical validation to us is benchmarking, and benchmarking means back testing or forward testing a trading method to record every trade it generates to the letter of the trading plan to capture the statistics of that method to determine if the potential outcome is worth the risk. You have to do that for the method you're following. You have to back test it. See if I have a back test spreadsheet up here really quickly. Yeah, here's a back test. Here's a benchmark of our day trading method in the dollar yen. You can see it has a ton of information there. It tells me how long the setups are: 6-hour setup, 5-hour setup, 12-hour. It tells me what day. Like, I used to think that Fridays are bad luck to trade because it's the weekend. When I look at the statistics that the method's bearing out, no, Friday, there's nothing wrong with Fridays to trade, right? So this is what we mean by a benchmark. You need to calculate. You need to tabulate all the trades that your method produces, so that you have that information at your fingertips. And that we're just giving you the definition of it right there. Definitely to benchmark a method, you're going to need, number one, a static trading plan. That means that the trading plan doesn't change. It's the same trading plan over and over and over again. Okay. Hopefully, you know what I mean. So the trading plan we use, and we'll get to that, it's the same plan no matter what market, no matter what time frame, even no matter what what the timing of, no matter what session I'm in. My trading plan is always the same. So you need a static trading plan. Also, benchmarks are hypothetical because you are recording every trade 24 hours per day, 5 days per week, and then you're managing those trades to the letter of the trading plan. You guys all know this, that I know it all, and I'm all too familiar with it, also seeing it in our students and even myself too, where your trading plan will call you to exit a position at X level, exit 2/3 of the position at, say a 17 tick profit, and then manage the balance of the position using momentum. Let the profit run using momentum. Well, a lot of times you get to that 17 pip profit and you'll just exit the whole position. Or you'll get 10 pip profit and you'll exit half the position. And when you get to 17, you'll exit the other half. Well, that's fine. You made money, but you're not sticking to the trading plan. You have to stick to that trading plan. At the very least, in your hypothetical backtest, you have to stick to the plan in the backtest. That way you know the statistics of your method are going to bear out. Okay, you're going to have as good of an idea as you can anyway that your statistics will bear out, that they'll be accurate. So people say, a benchmark is hypothetical. That's not good. It is good. I'd rather see the hypothetical results of a method because then I have a good idea that it can be replicated as opposed to someone going in there and just trading it kind of haphazardly with their emotions involved. Benchmarking, extremely important. Benchmarking validates your trading plan and is an indication you're ready to move from analyst to demo trader or from analyst to trader. And here's our trading plan. Here's a static trading plan. And here's what we mean by that. It's the same. This trading plan doesn't change at all for us at all. I mean, it's the same signal. It's the same trade management. It's the same method, buying dips and uptrends, on-in buy zones, sell rallies and downtrends, on-in sell zones. I mean, it's the same thing over and over again. Here's the method here's the dollar yen for our method today, and for the first time in a long time, there was no trade. There was no trade because my zone's down here. And now I could draw a shorter term zone. I really didn't feel like doing that. It's the holidays. I'm patient. So I need price to get down in here for my zone in dollar yen. So nothing to do there. Here, let me show you in euro. There's my euro. There was really nothing to do. Yeah, I mean, there really was nothing to do here. In euro either, you could see there's my zone. Didn't quite get into it. Didn't get cheap enough for me here. I was hoping it would have got into it here. And it never did. So I'm just patient. It's no big deal today. Holiday market. Things are really slowing down. It's just, that's how it is today. Nothing going on. Right? Here's one, actually, a futures chart. We had a trade here, and I was slow to see it. I was just slow to see this trade. And here it is. And that's all based on this method. You can see there's the purple line. That's the zone. The zone is between this purple line and that green line up there. And you got to the top there, and right there, here, I'll go down a lower time frame so you can see it. Right there, that's a signal. That's a signal to get short in that zone in the 10-year futures. So I kind of missed that one. I was chatting with some clients. I mean, it just happened like 15 minutes ago. I wasn't used to that futures chart either. That's a different chart. So you can see there it was, here, maybe see it on the 15-minute a little better. Here's the zone, but between that purple line and that green line, that's my zone. So anytime I got in that zone and I had double top in there, I was looking to sell it. That's the 15-minute. You can see a little better on the 2-minute here. So that's a method trade. But I looked all morning. That was the first trade I finally saw, and I actually missed it. I was a little slow on the draw there. But all that comes from this trading plan right here. This is the same trading plan whether I'm trading the yen, the euro, the 10-year notes, the gold market. It's the same plan. It's the same method, setup, signal, management. It's the same. That's what we mean a static trading plan. You have to have a static trading plan if you're going to get these results. Okay? You're not going to be able to trust your results without the plan. So here's the trading plan. Once you have the trading plan, you get the plan, and then you can get a back test like that. You get a benchmark spreadsheet. So statistical analysis, to me, that's the only thing I'm going to listen to right now. At my experience in trading, at my age, just show me the results. Okay, show me the results. Show me that those results can be replicated. That's key. So you need that static trading plan. So you need a trading plan. You need one of these to get one of these, and that's really the bottom line. 4 things we're going to show you today that you absolutely have to know in trading. Well, you have to have a trading plan that's going to give those to you. Number 1, you need to know which levels to buy and sell at. This is fascinating. Most people, this is the last thing they learn. This is the last piece of the puzzle. No. This should be the first thing. Which level? Because which level is going to tell you whether a market's bullish or bearish. And we'll show you how that works. So it's the level. What level? I don't care what market it is. I don't care whether you're buying or selling. You want to know that level because that level is going to be support in an uptrend, okay? Support, imagine that support in an uptrend. That means price came down to support, so you're buying a dip in an uptrend. Very, very important, the level first. I want to know the level before I want to even know the market. Number 2, which market and direction to focus on. Most people put this first. they want to know the market and then the direction. That should be number 2. It's the level. Because I'm buying a dip in an uptrend in the euro, or I'm selling a rally in a downtrend in the 10-year note, right? Yeah, I'll show you my sell signal again. Why was I looking at the 10-year note? Here's the longer term chart of that 10-year note. Well, you can see in the 10-year note it's a downtrend, right? Overall, it's in a downtrend. So if it's in a downtrend, I'm trying to sell a rally, and here's my little zone I carve out there. Drop down to all the way to a 2-minute chart. It's a whole lot. It's a different world down here. There it is. That's actually a 3-minute chart, but that'll do. That pivot was in the way too there. Get that out of there. Here's my sell zone, right? Selling a rally in a downtrend. Here's the sell zone here when market changes direction right there. That's when I want to get short. So it's that level comes first, then the market, and then direction, okay? But number 2, very important, which market and direction to focus on. That should be number 2. Number 3, then, that's when to buy and sell, okay? So here, I'll go back and I'll show you that, give you an example on this chart. Here's the 10-year note. This is the trade. I finally found a trade today. It was short the 10-year note. Number 1 is level, right? This was the level between that purple line and that green line. That's my zone. That's the level I'm interested in. Number 2 is the market and the direction. Well, the market was the 10-year notes. The direction was down because I could see I'm in a long-term downtrend. Number 3, when to buy and sell. Right here. That's when I'm buying and selling. Okay, here when you had this short-term trend line break right there. And I do mean short-term trend line too. I like a short-term trend line. I already know which level. It's got to be at that level. The market's got to be in a downtrend. I already know I'm going short, so I want a short-term trend line. So right there, bam, I want to get short right there. Right, so that's when to buy and sell, and that was all important number 3, when to buy and sell. And number 4, that's how to manage your trade. And you're going to manage that trade the same every time. For example, here, let's say I'm short here at 123.20 and a half. So once I get the sell signal, I put in a limit order to sell it at 123 or 123.20 and a half. It trades 21. It trades through me. What's nice in the futures is if I trade it at 0 and a half, I put a limit to sell it at 0 and a half. It trades 1. I'm guaranteed to fill. So I'm guaranteed I'm filled here. I put my stop. So if I'm short at 20 and a half, I'm going to put my stop above the isolated high at 23. So I'm short at 20 and a half. Got to stop at 23. That's 2.5 ticks. Okay. Let's say my profit objective is 2.5 ticks times 1.5. Everyone follow me? My profit objective is 1.5% of my risk. So in other words, I'm going to risk 10 pips, I need to make 15, right? Here in the 10-year note, I'm risking 2.5 ticks. So 2.5 ticks times 1.5, that's 375. So if I'm short at 0.5, 20.5, I need to make 3.5 ticks. So it's got to go to 17. Wow, look at that. Guess what the low is? 123.17. There's no guarantee I would have got out there now, and it would have had to trade through me. But pretty good example of why I'm going with a 1.5 risk reward. Now, if I go with a 1.4 risk reward, then I'm going to get out of that trade at 17.5, right? Or I go with a 1.25, then I'm getting out. So you could see the shorter my risk reward there, the more likelihood of success. That's the key to trading. You're not going to get a 3-to-1 risk reward all the time. Professional day trader, and most traders are day traders too. I mean, if you trade every day in the markets, you're a day trader. And by the way, you're not trading on a 5-minute chart. You're trading on tick charts, right? I'll give you an example in the 10-year note here. You'd be trading on a 100 tick chart, and it's a whole nother world there. Well, I apologize. It's market's a little bit slow here to. Got too many things going on, but you get the point, right? That professional traders, they're trading very short-term charts. So that's a perfect example on how to manage a trade using that 1.5 risk reward. Okay, how to manage your trades. It's extremely important. Now, you want to have all this spelled out way ahead of time because you don't want to be thinking when you're in that trade. When you got all that risk on and you're in that position and you're nervous and your leg is shaking and your mind is looking around and you're thinking about this and that and oh, here we go again. You don't want to be thinking about how to manage that trade. So that's why you need that how to manage that trade spelled out ahead of time. Okay? Number one, your trading plan needs to show you, we're going to reiterate this, which levels to buy and sell. Okay? I'm going to show you why that's so important, why buying and selling, where to buy and sell is so bloody important for us, okay? Here's a crude oil market, okay? Here's the crude oil chart, and this is what we call right there, that's what we call a risk tolerance threshold zone, okay? The premise here is very simple. As long as price is below that zone, this overall pattern, we call that a risk tolerance threshold pattern, as long as price is below that zone, this overall pattern is bearish, okay? Very, very simple concept, okay? Here's the Canadian dollar, the ETF. Here's the cash Canadian ETF. It's the opposite of Forex, and very simple. And by the way, this level right there, that risk tolerance threshold level, that's the same level mathematically as we showed you here in the crude oil, okay? That's the same percentage retracement here as it is here. Okay? In mathematical terms, all these levels we're going to show you are identical. This is why this particular level is so important to us. Okay? And what I say, as long as price is below that line, this overall pattern is bearish. That's so important to us to know that pattern is bearish because that's going to tell us whether we're selling rallies or buying dips. Right? Very, very important to know that pattern is bearish. This risk tolerance threshold line is going to tell us. That's why the level is so important. Here's dollar CAD. Here's a Forex chart. There's that level. There's that. We call that a bullish risk tolerance threshold level here. As long as price is above that line, this pattern is bullish. Okay, so you could be in the lower third of this box, yet the pattern is still bullish. That's amazing, isn't it? So literally, well, if you're looking short term, you're looking here, oh, maybe the direction's down, but it's the pattern we're keying off of. As long as you're above that line, right, this overall pattern is bullish. So it's that pattern is so important in any market, that particular level. What I'm showing you here is a static pattern. It's the same pattern in every chart I'm showing you. Here you have three of the same pattern, okay? That pattern's bearish. That pattern's bearish because it stayed below that level. Boom, boom. It stayed. Price couldn't close successively above that level. Here it is again, stayed below the level. This is gold. Gold is a fantastic market for holding a pattern, by the way. So it's very unlikely once a trend is established, it tends to stay in motion, right? A body in motion, physics. Very definitely a market is a body when it gets in motion, for sure. And there's that same pattern. This is a series of bearish risk tolerance threshold levels. So as a trader, obviously, we want to be getting short here and here and here, right? So as long as price is below that level, the pattern remains bearish, and we focus on sell signals. And here's dollar yen. Here's the same pattern in yen. Oh, I went too fast here. Here's a short-term one. Here's an overall one. And here's boom. Here's another one. Here's another one. Okay? It's the same pattern over and over again. Now, what I want you to know here is this isn't some recent phenomenon of quantitative easing or mass government intervention. It's a simple pattern that Charles Dow recognized over 100 years ago, and that the author Robert Ray wrote about in his book, The Dow Theory, okay? This is straight out of Dow theory. There's nothing new about this, okay? It's been going on 100 years. Probably been going on as far back as, when Egyptians started trading cotton. It wouldn't have surprised me that, you saw that same familiar pattern. Okay? Here's that same pattern again in dollar yen, and an important point I want to make here is that, again, there's nothing new about the pattern, right? Here, I think we jumped ahead a little bit here. Let me back it up because I wanted to show you. I want to make the point that there's nothing new under the sun about this pattern. Here it was in the dollar yen, and you can see it just a series of those patterns. Here it is, yeah, in the euro, and this is before you had the big rally a couple of weeks ago. Okay, you can see how it was set up. Here's a simplified way to look at it. The big box is the long-term pattern. The intermediate-term box is the intermediate-term pattern. The small box is the short-term pattern. So you can see all these patterns overlapping. So when the key is when you have the majority patterns going one way, and I say majority, so if you have 2 out of 3 patterns aligned, then that's the direction I'm trading in. Okay. But here's the point I want to make. There's nothing new about this pattern. This is Apple chart from 6-7 years ago. This is 2006, and you can see there's the pattern, and there's the overall pattern. So while this intermediate-term pattern shifted bearish here, the long-term pattern remained bullish overall. So you have to focus on those patterns. Okay. So what I'm showing you here is it's really a holistic approach to analyzing and trading. And the most important thing, it can be statistically validated. This pattern itself, you can go back and see exactly how it was. So if you can go back in time and see what a pattern was, and then you could see how your own methodology traded based on that pattern, then that means that you have a valid benchmark, because you have a pretty good idea that you're going to, whatever results you got going back in time should hold up going forward. Okay, and to me, anybody's method, I don't care if it's Elliott Wave or your own method. If you use our benchmark method, if you use our benchmark pattern recognition techniques in a market to show you which way to trade, I think it's going to make an improvement for you. So to me, the most important thing in trading is knowing whether a pattern is bullish or bearish. Because once you quantify that variable, is it bullish or is it bearish? Once you quantify that question, then you can apply that same measurement to determine the direction on any and all time frames in any market, right? And here I showed you Apple in the previous decade. This is IBM back in the 90s. Okay, here's the same pattern in the 90s. Boom, boom. Okay, very simple pattern. You're buying a dip in an uptrend, and it's the same pattern. And from a retracement standpoint, from a math standpoint, that's the exact same pattern here as it is here. Okay, trade through it, but as long as you don't trade below, as long as you don't close below it successively, that pattern's good. Okay. Now, why do you think that is? I guarantee people have stops there. I guarantee you here people had stops just below 14. Boom, they got stopped out. I guarantee they had stops just below 18. Boom, they got stopped out. We love that pattern because this is an excellent place to trade, because this is where people are exiting at the exact wrong time. This is why we call this level a risk tolerance threshold level, because this is the risk tolerance threshold point. If you bought IBM here and it went up and it came down, I guarantee you 14 is going to be your risk tolerance. Whatever it is, that psychologically, whatever it is, but it backs up that far against you. It gets to that level, you're going to throw in the towel, you're going to quit, right? That's the uncle point for most traders. They say uncle when you're a little kid, you're twisting your little brother's arm, you're going, say uncle. Once he says uncle, you stop. It's like a kid's game. It's the same thing in the market. That's the uncle point. They've had enough pain, they exit there. So you want to be getting long, you want to be looking for buy signals on these lower time frames at that level. Here's the same pattern in silver going back into the 80s. I just showed you IBM in the 90s. Here's silver in the 80s. Look at here. Here's the bullish pattern. Same pattern. Now here's what it tops out. Once it tops out, then the pattern shifts bearish. Then here's a shorter term pattern bearish. And then here it is, the same pattern bearish again. So that pattern is so helpful in helping you stay on the market. And basically what I've just given you is a mathematical model to measure higher highs and lower lows. Or I should say higher lows and lower highs. As long as you're having higher lows, it's in an uptrend, right? Once you start getting lower highs, then you're in a downtrend. And this is silver in the 80s. Now we're going to go all the way back to corn in the 70s. Same pattern, same retracement level. It's the same, okay? The long-term pattern here is bullish. It's a weekly corn chart in the 70s. Corn got below 220. all the farmers thought, oh my God, it's going to go to $1.50. Corn, this is terrible. Well, as long as it held that retracement level and it held it to the penny, it was a bullish pattern. Then you get this smaller pattern right there. Brothers and sisters, you better be getting long corn right here, right? That's the time to get long it because you have two patterns aligned and boom. So we're making that point that there's certainly nothing new about this particular pattern, okay? So that's why level is so important for us. And once you know that level, now you can focus on which market and direction to focus on, right? Very, very simple stuff. This is the gold market about a month ago. A little over a month ago. When I made this is the gold market when I made this particular presentation, okay? Very important that you understand the patterns here, okay? What's that? That's my long-term pattern. Why is the long-term pattern bearish? Because the long-term pattern is bearish is because you're below that risk tolerance threshold level, okay? Here's my intermediate-term pattern. The intermediate-term pattern is bullish. Why is the intermediate-term pattern bullish? Because it's above that risk tolerance threshold level. How about my short-term pattern? Here's my short-term pattern. My short-term pattern happens to be bearish because I'm below that risk tolerance threshold level, right? So what do you have? How do you break this guy down? You've got two patterns bearish, one pattern bullish, right? A lot easier way to keep track of that. We have a market ratio. So when I look at my ratio there, you can see on the chart, I have the majority of patterns are down. Okay, so rather than have all those lines on the chart, we created a ratio. So if the ratio is bearish and we get a sell signal right here, that means we're going to be a seller, right? And let's see how that worked out in the gold market. Boom, there's the sell signal, and there's what happened to price next. And if you look at gold now, gold is actually below $1,200 now. So, you've got to follow the pattern in the market. I mean, it's just from our perspective, it's pretty simple. So when you see that pattern's bearish, you have a pretty good idea that that's the way you want to trade. So very, very important to know that market, know that pattern in that market ahead of time. And what we're showing you is we're defining a risk tolerance. We've defined a risk tolerance threshold level for you. We just showed you a risk tolerance threshold ratio. So you can take all those patterns in a market and you can build a ratio, okay? And when you have that ratio built, then you have it's crystal clear to you which way you want to be trading, okay? So we've created the ratio as a solution for determining which direction the different time frame patterns in a market are aligned. And we've used that as the basis for a trading method that eliminates the need for you to figure out which way the market is going to move next. You don't need to know which way the market's going to move next. You just trade in the same direction as the pattern is telling you. Okay, and it's not something you need to subscribe to. It's not a secret formula. It's something that's very simple that you can calculate for yourself, and we teach our students how to do that. So you can come up with your own ratio for whichever market you follow, right? And here's just an example of it. You can hear at the time the euro ratio was bullish, right? So this was the December unemployment number in euro. So when you had all the numbers bullish, all you're doing is, once it gets to the pivot point, you have a pretty good idea that you want to be a buyer, okay? So when everyone else is thinking, the unemployment number came out very bullish for the U.S., the euro's going down, the euro jumps down initially. But once you see the hold on support, it has done no technical damage. Your 5-day pattern is still up. The majority of patterns are still clearly up. You realize, hey, I don't want to be a seller at all. I don't care what that number said. I don't care what the people on CNBC are saying. I know that I want to be a buyer here because my ratio is telling me up. Okay? Very, very important tenet in our trading. Very, very important philosophy I carry that I believe wholeheartedly is the truth, and that is the pattern on the chart is absolutely a representation of the underlying fundamentals in a market. Okay? I'll say that again. The price pattern we see on the chart is absolutely an accurate depiction of the underlying fundamentals in that market. Therefore, when I see that my 5, 10, and 25-day pattern are all up in the euro, I understand that there's underlying support. There's underlying fundamental bullish element to this market. And I don't care what that underlying fundamental bullish element is, whether it's central banker support or whether it's Deutsche Bank and Bank of America getting together and running stops above the market. Okay, maybe that's a poor example, but I really don't care what they are. All I know is that I'm trading with the fundamentals, the underlying fundamentals. The reason why a market does what it does, I'm aligned with that as long as I'm trading with that pattern, and that's just my belief. That's my belief system. Very, very important one for me, though. And again, we're just focusing on which market and direction to focus on and why that's so important, because you have to know these things ahead of time so that you can benchmark it, so that the data that you accumulate from your trading plan, you have a pretty good idea that can be replicated going forward. Now, here's a really good example. You can see with the naked eye that what happened, you had a series of higher lows. All of a sudden, boom, now you're having lower highs. Well, you had the higher lows. Now you're seeing lower highs. What was my ratio at the time? Right here, even though I was seeing short-term lower highs, my ratio was what? It was still bullish. The majority of patterns were still up. Only the 5-day was down. The 10-day and the 25 held up. So when I get to this level, I'm actually looking for be a buyer here. Now, short-term traders, they may be looking to go short here because they see the pattern has shifted from one of higher lows to one of lower highs now. But when I understand this is just this is the hourly chart. I look at my pattern and I see that the majority of patterns are still higher. Therefore, I'm still a buyer. Okay, so I have a big edge over the other short-term traders because I'm not a seller on the way down. They may make a little money here selling it, but I'm still a buyer. Okay, I'm still focusing on buy signals at my level, at my zone. So you get it to the bottom of the zone there, that's where I'm looking to be a buyer. Okay. So it's very, very good at keeping you focused on what that market's doing. Here's another really good example. In this particular market, the 5 and 10-day patterns are down. I'm giving you that. The 5 and 10-day patterns are down. This is the U.S. stock market, though. U.S. stock market, long-term bull market. What's the ratio tell me? I always want to know the ratio. I don't care what the news says. I just want to know what my ratio is. Well, the ratios tell me that long-term, this market's still pretty bullish, okay? The true beauty of this ratio is you can go back and measure its effectiveness in whatever market environment you're in. So even though the 5 and 10-day pattern are down, maybe short-term traders are looking to sell rallies in the stock market here. I'm really not, because I like the big picture too, especially you take an established market like the stock market where it's got a big fat dividend. And yeah, I tell you what, they didn't design stock indices to go lower. They really didn't. They designed a stock index to effectively measure the better companies in a market. And what are the better companies in a market going to do? Well, the best companies in the world tend to be profitable, right? Drew had a question. I wrote a book on the RTT ratio, and I'll try to get the link. I'll get the link to the book for you. I'll do that right now because I forgot to do that last time. But the RTT ratio is a fascinating tool. It's very simple. It's something you can do by hand, and it's going to keep you on the right side of the market. And as an example here, it did it in the stock market. Again, stock indices aren't designed to go lower for the most part. So if that market happens to be, if the ratio happens to be bullish, what do you think the market's going to do? There's what the market did right there. Shifted everything back higher. Okay, so despite that 5 and 10-day down, didn't matter. Boom, the market hit support, and the weekly pivot held, and up the market went. Now the market made a higher higher. So the market shifted everything higher right there. And you guys are asking about the RTT ratio here. Let me give you the link to our book. I wrote a book on that. That's my latest book. very, very simple tool, very effective tool, by the way. And here's another example. Okay, here's the dollar yen. I remember this distinctly because I wrote an article about it. I said they've done no technical damage to the yen here. Now, if you're just looking at this chart, you're thinking, oh, that's ugly. That's an ugly chart. Look, the yen tried to break above 99 even. I remember you had some buy stops above 99 even. They sprung those, and then they went down. They sprung the buy stops above 99 even, then they sprung the sell stops below 90.80. Well, the professionals reset the yen here. Okay. Well, first thing I want to know is what was my ratio? Okay. What was my ratio telling me? Majority patterns are up. What is that line right there? That happens to be right there. That's my pattern line. Okay, so this overall pattern is still bullish as long as I'm above that. This individual pattern is bullish. The majority of patterns are still higher. Therefore, I'm a buyer. I'm looking to take buy signals down here, right? And what happened next? There you go. The 5-day shifted higher. That's that same level, and the market ended up being much higher. It's like at almost 104. It eclipsed 104 last week, right? So the market went much, much higher. All it's doing is trading in the same direction of that ratio. Okay. And here's the book. Drew, if you were asking about the book. Here's the book. I'll put it in the window there. Hopefully you can see it. And that's that book is about risk tolerance threshold theory. Secret to trading, risk tolerance threshold theory. It's all about that RTT ratio. So, number 3, now you need to know when to buy and sell. We showed you the importance of where, that you knew that level. Now you know the importance of the market and which direction, and that RTT ratio tells you that. Now we're going to show you when to buy and sell, right? Here's what we define as the trade setup. Confluence of support. Anytime you have a confluence of support and the market's dropping down to support and your pattern's bullish, you want to be a buyer. Okay, and this is actually the unemployment report, the December unemployment report in the euro, where it went down, a very bullish number for the U.S. And everyone thought, oh, it's a bullish number for the U.S. The euro's got to go down. Well, the euro just went down. It set you up, gave you a buy setup. Buy signal. Majority of patterns were up. Market found support on a confluence of support. In this case, you had the central pivot and you had a 382 retracement. Boom, the market's going up. Okay, if the market's going up, it's going up. It doesn't care about who thinks otherwise. It doesn't care about the headlines. Mother Market, I'll tell you something. Mother Market is cruel. Okay, she does not give a rat's arse about what you think, about what I think, about what Mike Bloomberg thinks. It doesn't matter what we think. The market's going to do what she's going to do every time. So that's why it's so important to not listen to anything else but her, okay? If that short-term pattern is bearish, that's telling me something, okay? If the 2 out of 3 patterns, or in this case, if all patterns are bullish and the market's dropped sharply to support, I'm looking to buy a dip. I'm looking for buy setups, not sell setups. And this is why markets trend, too, by the way. Okay, here's another example of a buy signal in the zone. And this is just a short-term chart. This is from the same day. I gave this same webinar 2 weeks ago on a Monday, and this was a buy signal on a Monday that day. Okay, that was the signal that was given that day in the zone. The most important thing about a setup from the standpoint of benchmarking is that it's consistent, meaning the criteria you are specifying that must be in place before you enter a trade must be the same every time. Okay? Here, in this example, this is an example where essentially you're buying a dip in an uptrend, right? Yeah, you're buying a dip in an uptrend into the zone, okay? It's the same zone every time, same conditions every time, right? And I'm going to show you the trade today. Here's the trade today where here's the zone, here's the purple line and the green line. There's my sell zone on this day. And here you can see it on, this is a 15-minute chart. If I go down to the 2 or 3 minute chart, you'll be able to see it. There it is. You can see it more clearly. There's the zone. Okay, you got to see that double top between the purple and the green line. Okay, that's my sell. That's my sell setup. Here's my sell signal right there. I showed that to you. You're going short there. You're going to take half of the trade off. Remember, I showed you at 1.5 times my risk. So you come out of half of the trade at 17, and you're going to let the other half of the trade run. Okay, and you're going to manage that second half of the trade on the 15-minute chart. Here's my 15-minute chart. You can see. Hopefully hopefully the market starts accelerating lower because we're short on the 2-minute or 3-minute. Now we're going to manage the second half of that trade on the 15-minute. So this setup here is identical. All the conditions are identical to this setup in the 10-year note you're looking at as for this euro trade 2 weeks ago. Okay, all we're doing is buying a dip in an uptrend or selling a rally in a downtrend. At the time, your ratio was bullish, right? You happen to have all of them up. 2 out of 3 up, I'll take that signal. So the point I'm trying to make is this is a benchmark. A benchmark means it's the same over and over again. So it's literally the same criteria over and over again. Okay, the most important thing about the setup from a standpoint of benchmarking is that it's consistent. Here's another example. Here's gold. People think I pick on gold. No, I pick on gold because it's a great market. It really... It just holds up so well in the method. You know, it has such clean downtrends. And again, it's the same thing every time. This is that purple line's a 50% retracement. So here's a double top on a 50% retracement. It's kind of a no-brainer. Okay, when your ratio is telling you that the 5, 10, 20, and 50 are down, and you get a double top, basically you get a rally to sell. Okay, you have the nice downtrend. Then it comes back, and here's the 50% is usually the bottom of the zone. So you get a double top at the bottom of the zone, you got to be taking that sell signal, okay? And that's a sell signal in gold a couple weeks back. Next, of course, you need to know how to manage your trades, okay? And here's a good time to remind you, trading involves risk loss is not suitable for everybody. You have to have a trading plan, right? Here's how we manage ours. Place stop beyond previous swing high and low and sit tight, okay? You can't teach people how to sit tight either. Try to tell like a 4-year-old kid, okay, sit here, don't move. They're not going to do that, are they? Well, we're the same as that 4-year-old kid. As soon as we get in a trade, we get all antsy, we get all jumpy, our scalp starts tingling, our nervous habits start coming out. You got to learn to sit tight. The way you're going to learn to sit tight is here's how you learn to sit tight. You have to have one of these where you know how that performance of that method's going to go. Okay, you've created this yourself. You went back in time. You know you have this in hand. You create it, so you know it's not bullshit. You know exactly how that methodology performs because you're the one that crafted this. Okay, you take your method and you build one of these. Okay, once you have one of those, it's going to be so much easier to learn how to sit tight, okay? And then exit half to 2/3 at a 1.5 multiple of your risk and then manage the balance with momentum, okay? Pretty simple. It really is simple stuff. Well, a very, very smart man once told me, simple is not the same as easy, okay? Something that for me is very simple may take other people years and years to get to that point, okay? But bottom line is you have to have a trading plan, okay? Here's how you manage that trade. Always trade multiple contracts. Base your initial reward as a percentage of your risk. Use momentum to manage the second half of that position, okay? People are looking at a MACD to get into a trade. MACD measures momentum. Why would you be looking at momentum to get you in a trade, okay? Maybe if the MACD is already going in the direction of that trade on a longer time frame, that's good, but you don't use a MACD. Same thing with stochastic. We don't use those to get into trades. You don't use that to get into a trade. You use them to keep you in a trade, right? Well, I'm running out of time here, so let me just wrap it up. The bottom line is what you need to be doing. It needs to be the same every time, okay? And here's a nice example in the yen futures of a sell signal right there, right? Got to the top of that zone, boom, went down. Okay, that was a trade made 2 weeks ago, right? So you definitely have to be using a benchmark to provide that assurance that the method that you use is valid and can yield desirable results or not, okay? When someone's saying, hey, check out this method, say, well, let me see your benchmark. And I don't really care about trading statements, although that's helpful too, but what you really want to see is that over time, the method is going to produce those all-important desirable results, okay? Really what it comes down to is the benchmark is going to tell you whether your trading plan is cutting it or not, right? And here's a student of ours, Laurent, from Paris. Laurent, he's in IT. He sent me, this is his benchmark, and you can see he was doing pretty good. It was a little choppy at first. His first four trades, 3 were losers, but he stuck with it over time, and then he ironed it out, and he started putting up really nice results. So thank you, Laurent, for sending that to me and sharing that with me. And these are just, you know, the importance of benchmarking. I mean, it should be self-evident that you definitely need to be benchmarking your trades for sure. And here, if you want to know what we do and what we teach our membership, basically we teach you to do all this. We teach you our benchmark method. It's $199 per month membership for 6 months. You pay per month for 6 months. At the end of 6 months, you get a free lifetime. Okay, it's free for you. Now, the reason we pay 1 month at a time is because if you don't believe in what we're doing, we don't want you to continue to feel you have to pay. Okay, so you pay $199 up month, you get access to everything up front. In your first month, you get access to the advanced, the graduate, the master's course, everything. Quizzes, one-on-one mentoring, Skype chat group. You get everything, okay? Live interactive classes. So for $199 a month, you get access. If you don't like that, you're certainly not going to continue to pay for the other 5 months, right? So if you like it, you'll continue with the program. If you don't, you don't. That's perfect, right? So you get 6 months in there, 1 month at a time. And here's our website, and basically that's what we teach you here. I'll give you a link for a trial here if you're interested in it. But thank you guys so much. Thank you, FX Street, and we'll see you in the coming month. There's the website if you want to find out about it. Here, I'll give you the link for a trial. We're unique in the industry in that we don't charge you up front. We charge you per month, and if you like it, you'll continue to stay with us. Really, that's our guarantee. It's a pretty unique guarantee that if you like us, you'll stay with us. If you don't, we certainly don't want you to continue to pay. So you pay 1 month at a time. Yeah, thanks, everybody. Here, let me drop you that link. Tells you a little bit about how we do it, too. Okay, there's the link. Dropped it in the box there. Good seeing everybody. Thank you so much. We appreciate your participation, and we'll catch up with you guys next time.